The big conversation in the markets right now is whether the US can maintain its dominance as a global economic superpower. And lots of people say, that's not the case, it's all about Tesla earnings. You're too zoomed in. Let's go ahead and zoom out, look at the 50,000 foot view of what's going on in the markets so that we can understand what's happening in the stock market and what that has to do with the bond market and how it all revolves around the value of the US dollar. Right now, most of the major banks have called for a recession in late 2023. And if we actually have the AI do some scanning for us after looking through 23 links, it's also provided back that the general sentiment among financial institutions indicates that many are preparing for a potential economic slowdown in the near future. Now, since this is the case, what I should see when I look at the stock market is that the indexes are selling off and that people are buying up bonds, especially long-term bonds. Instead, when we look at the stock market, we can see that bonds are not getting any buyers and in fact showing a lot of weakness, especially today. We had a big drop off as well. And when we look at the indexes, they're holding up really well, especially, if we look at the 3-year graph for the S&P, we haven't hit a new high, but we've hardly seen some pre-COVID levels that I've been calling for a while now. Instead, we're well above the lows and it looks like the market actually wants to break out here. It's a very confusing picture that might make you think the market's just being irrational and doesn't make any sense unless you're paying attention to the currency conversation and the value of the US dollar. However, you have to also understand how you value a currency. The value of a currency is dictated by the health of its debt. And with the recent banking runs causing a banking crisis, the conversation has really been reignited on how healthy US debt is. The newest Federal Reserve programs to save these banks may inject another $2 trillion into the US banking system. And remember, this isn't counting what could potentially happen when it comes to commercial real estate if there's going to be another crisis there, since most offices are completely empty right now, or with the consumer who has historically low savings accounts with inflation being high, a recession on the way, and lots of credit maxed out. And so all of this ends up having the effect of people not buying bonds because bonds are just debt and they don't want to hold that debt, which then leads to the currency being devalued because the debt doesn't look healthy, which then leads to the stock market going up because if the dollar's worth less and buys less, it makes companies worth more. For now, remember, a lot of this is based on the thesis that the US is in trouble of losing its throne from being the dominant currency of the world. Now, if you're not new to my channel, you've likely heard me talk a lot about how unrealistic it is for someone to displace the US right now. But today I'm going to do something different. I'm going to recruit some help from a former multi-billion-dollar hedge fund manager, Alf. Alf writes the Macro Compass Substack. It's an excellent Substack. You're going to find a link down below for that. And he also is so good at articulating his ideas out. In this article, I feel like Alf puts together things that I've been talking about on YouTube for a while, and I just wanted to just go ahead and just go over exactly what he's written, especially when he's titles carry so much more than me, a random YouTuber, I know. But this is also clarification that, hey, I do my research to the extent that even hedge fund managers are coming out saying the things that I've been saying for months. 80% of global FX trades and 50% of global trade payments happen in the US dollar. US dollar accounts for a lion's share of global trades and payments. I mean, just look at this. Look how dominant this is. FX transaction value over 80%, global GDP over 20%. That's out of the entire globe. It's massive. And people think that the US is going to be displaced. But and as Alf says in here, being the US dollar seems fun from the outside, but it ain't easy. Exactly. Now, one of the things he's doing in this article is he's talking about a recent speech that happened in Brazil where they're trying to not have to use US dollars. But he's explaining in this article one of the major things that keeps people coming back again and again and again to US dollars and US Treasury market. Because remember, a lot of countries want to buy the bonds of other countries because it gives them a stable amount of returns. And the US market is the most dominant because it's safe and liquid. Remember, we're talking about a 20 trillion plus size market. Okay, that's why it's the global leader in its field, because it's liquid and underpinned by a deep repo ecosystem that ticks all boxes, right? Because if a country wants to pull out $5 trillion, there's only like 3 candidates that they can go to even do that. The US is therefore the safest because it is the most liquid, because it is so easy to get that money out. So when you're talking about displacing the US from its dominance, you'd have to also be talking about who can actually displace them. Japan, with its government bond market being 60% absorbed by the Bank of Japan. There have even been multiple days in a row where no trades at all happened in its bond market. Europe, with a fragile monetary but non-fiscal union, and the only AAA countries potentially able to provide the world with safe collateral are the German bonds. It's like their bonds. AAA is the grade you give to bonds, okay? To be a top-rated, safe asset, you need to have the AAA rating. And the only one in the European Union is the Germans that even have that. China, Brazil, Russia, combination of capital controls, China, lack of democracy, rule of law in Russia, corruption, and frequent episodes of double-digit inflation in Brazil. Do you want to take these risks when storing your hard-earned FX reserves accumulated from selling your goods and services abroad? No, you don't. No one does. These are all horrible candidates. And then comes the conversation of debt. USD denominated foreign debt is huge, and it makes an orderly de-dollarization not more than a fairy tale. Remember, if you want to get away from using the US dollar as the reserve currency, you then have to unwind all the foreign debt that's denominated in US dollars. Because remember, these countries have to hold US dollars. And to explain that, he then uses Brazil as an example. So let's go over this. Entities sitting outside the United States have accumulated 12 trillion in US denominated debt. This is because to finance global businesses that sell stuff in the US dollars, well, you need US dollar debt. It is important to understand this concept. If you want to break this system and de-dollarize, you need to deleverage a $12 trillion debt system. Brazil walking away from USD-denominated trades would hamper its own organic inflows of US dollars, and Brazilian corporates would be choked under USD scarcity as they need to repay and finance their USD debt. Refinance their USD debt. When you deleverage a debt-based system, you are either bidding up the debt denominator or you are witnessing tectonic geopolitical events where world order is at stake. Now, a lot of this was probably confusing, but I'll do my best to explain it. When he says you need to deleverage a $12 trillion debt system, first of all, let's establish what leveraging means. If you leverage your debt, it means you're not paying it back. It means you're taking on more debt to pay it off, right? So if you want to deleverage it, you have to then go through and pay off all the debts, right? By not doing more borrowing. That means out of your pocket. Now, what this means is if you're paying off all that debt, you're going to bid up the debt denominator. That means the money you're paying off is worth more now than it was when you borrowed it, meaning that you're taking even more losses. And this plays into all the pressure it would put on Brazilian corporates, which underline the Brazilian economy, right? This would be heavily detrimental to them. It would be costly, it would be painful, it would likely cause a ton more issues to explode. And that's just for Brazil. And this is why an orderly unwind of the US dollar is a fairy tale. There's no valid alternative for a smooth transition. Indeed, leveraging the global USD debt-based system would be a very painful process. And this is why you keep hearing about the de-dollarization, but it never happens. It never happens. It comes up all the time. All the time we'll see the market temporarily act like this is a huge issue, or there's going to be a collapse, or we possibly can't print any more money than this. But then we do, and then everything is still fine. Now, maybe eventually we'll implode, as historically always the case. Democracies tend to blow themselves up because they can't stop voting to print more money. But are we there yet? That would be a multi-trillion-dollar question, wouldn't it? I still don't think we are. And in fact, I think this market is soon going to come to the realization that once again, we're still not there because no one's there to take up the space that we occupy at the throne. And that's it for today's video. I hope you found it informative, maybe even helpful. And tomorrow I'll go ahead and zoom back in and talk about the market as well because we killed this week. We killed this week. Anyways, I'll see you tomorrow to talk about that. And as always, stay positive. I haven't said that even once, but let's just act like that's always been the catchphrase. Stay positive. Yeah.